I don't know that that in and of itself makes that big of a difference. I mean, you could argue right now that inflation is far, far higher than we are being led to believe. It's kind of like the CPI is a funhouse mirror, right? It distorts what you're really looking at. It excludes food and energy and housing. You ask John Williams of Shadow Stats, he'll say add an 8 in front of the number, and that's what it really is. You're talking about 11%, not 3%. Your rent has gone up 20%. Your grocery bill is nearly doubled. Your insurance bill is down here in Florida is through the roof. The CPI from the Bureau of Labor Statistics, you could remove the L and call it the CPI from the BS, is something that I take exception with to begin with. So maybe it just actually has them be slightly more truthful. To me, the issue with the new Fed chair is, what are their policies? And one of the people that I've interviewed myself was Judy Shelton, who was his nominee in 2016 to run the Fed. And many people think she's on that short list of those that would be head of the Federal Reserve. She is someone who advocates for issuing a treasury bond, 50-year in maturity to begin with, backed by and deliverable in gold. She's told me, by the way, in no uncertain terms, that Trump has told her that on July 4th of next year, 2026, which would be the 250th year anniversary of the country, that he would issue these treasury bonds pegged to gold. Someone like Judy, who is a Austrian economist at heart, who understands sound money, who understands the principles of gold, understands that our treasury market has been weaponized and has lost appeal globally. This Western-based rules system that has really benefited the West is something that much of the world is pushing back against. And that's why since 2014, Gary, net, there's been no new central bank buying of treasuries. Now, there's been plenty of central bank buying, but not any new central bank buying. And now we have countries like China who are selling treasuries in favor of gold, which has outperformed the treasury for 25 years. Gold has outperformed by 2-to-1 the 10-year treasury since 2000. It was up 40% last year against 4% on the treasury. It's up 35% this year. It continues to beat the performance of the treasury, but it has no counterparty liability, no counterparty risk. And one could argue very much the same liquidity at those levels. And so this is a trend that we see happening. And to Judy's point, why would anyone want to take our treasuries in a world where austerity is thrown out the window, where the current administration, even with Doge, really can't do much to bring down the debt? In fact, they're raising the deficit this year another $2 trillion and wanting to get rid of the debt ceiling altogether. So the point of it is that I think it matters from a standpoint of who's in the chair. Is it someone that would understand the principles of sound money, or will it be more of the same of debt monetization and manipulated interest rates and all of the frolicking, if you will, or the shenanigans on a monetary basis, or let's just call it brain dead monetary policy that has got us into this pickle to begin with.
All right, so let's start with what I think is probably the biggest elephant in the global financial room right now, and something that frankly most Americans still don't grasp. And that is how this slow-motion train wreck of debt at every level, personal, corporate, sovereign, is colliding with a rapidly evolving global monetary system. Because look, we can talk about how Joe Sixpack's credit card is maxed out, how corporate debt is getting repriced from 2% to 8%, how commercial real estate is rolling over. And trust me, we'll get to all of that. But the truly seismic change, the one that will ripple through everything else, is the fact that the dollar's role as the uncontested global reserve currency is being openly questioned, not just in theory, but in action right now, by the biggest players on Earth. I've been saying for years that the weaponization of the dollar, starting with sanctions against Russia and now tariffs flying left and right under Trump's big, beautiful economic agenda, is accelerating this shift. Countries like China, Russia, Saudi Arabia, India, they're not just sitting around anymore nodding politely. They're building parallel systems, and you can see it clearest in how they're stacking gold, building out new gold vaults, launching yuan-settled energy contracts, and preparing for a post-dollar world. Let's talk China, because that's ground zero for this. Everyone likes to talk about how China manipulates its currency, how they're in debt up to their eyeballs, how they fudge their GDP. Fine. But what nobody talks about enough is how China has been preparing for exactly this pivot away from the dollar for decades, and doing it largely under the radar. Go back to 1983. That's when the Communist Party officially granted the People's Bank of China complete control over the nation's gold and silver policy. They set up a two-tiered system. On the one hand, SAFE, their foreign exchange administrator, managed their massive dollar reserves. On the other hand, the PBOC was quietly building a war chest of physical gold. They used the bear market from 1980 all the way through to the early 2000s to quietly buy gold on global markets, with Western investors happily dumping theirs. By the time the Shanghai Gold Exchange opened in 2002 and private citizens were finally allowed to own gold again, after being banned since Mao's time, the Chinese state had already stockpiled what many believe was north of 20,000 tons. Not the official 2,000 they occasionally admit to, but 10 times that. And then it got even more interesting. Once ordinary Chinese citizens were allowed to buy gold, the floodgates opened. Since 2002, roughly 27,000 tons have been delivered out of SGE vaults into private hands. And here's the kicker. Once that gold enters China, it never comes out. Ask the Swiss refiners. They'll tell you they almost never see Chinese bars returning for recasting. That gold is gone from Western markets forever. So you've got a country that by some estimates has over 40,000 tons of gold between state and private holdings, more than the rest of the world's central banks combined. And they're just getting started. They're the largest gold producer on the planet, and still a massive net importer. Now overlay that with what we've seen just in the past year. China's opening a major gold vault in Hong Kong, fully under the control of the PBOC. They're building another in Saudi Arabia. Why Saudi? Because Saudi Arabia exports an enormous amount of oil to China, and the Saudis want to be able to convert yuan into gold seamlessly. They're laying the groundwork for a gold-backed regional settlement hub. And just last month, the Shanghai Futures Exchange announced it's opening fully to foreign banks. Up until now, if JP Morgan or HSBC wanted to play on the Shanghai gold futures market, they had to set up a Chinese subsidiary. Now they can plug right in from London or New York. This isn't just about gold either. It's nickel, copper, oil, you name it. They're building a deep, liquid commodity market to challenge COMEX and the LBMA. Remember that massive nickel short squeeze on the LME in London last year that ended with trades being cancelled to bail out a Chinese whale? The East took notes. They're no longer going to leave the pricing of the commodities that feed their industrial machine in the hands of Western banks. Here's what's happening in real time. China is setting up the yuan as the alternative to the dollar. They're using gold as the neutral bridge asset to build trust. So when the dollar really does start to collapse under the weight of $34 trillion in debt, soon to be $40 trillion and beyond, they'll be ready to announce, overnight if needed, a fixed exchange rate between yuan and gold to stabilize their own currency.
So let's just cross our fingers and hope it's someone with a true understanding of sound money, of Austrian economics and libertarian viewpoints as it pertains to a more free market system, if that's even possible at that level. Yeah. That would come in and help right the ship. Well, it's funny. I could argue that they're kind of doing that in a very stealth manner already. They're supposed to be doing quantitative tightening, right? But 10 days ago, 2 weeks ago, they came in and very quietly bought $45 or $8 billion worth of 3, 10, and 30-year treasuries, a sampling of all three. Why did they do that if there is so much demand for it? You've had the Treasury come in and do two $10 billion week after week buybacks of longer dated maturity treasuries by issuing short-term debt to pay off the long-term debt, which can be very dangerous in the scope of things. Both things speak to the lack of demand for the Treasury, which is why even when they tried to lower rates, the 10-year yield went higher. That's the problem that we find ourselves in. If the Fed comes in and tries to lower rates when we clearly cannot normalize our balance sheet, when we clearly have chosen inflation over austerity, when we are clearly going around the world and imposing tariffs and sanctions and weaponization of the dollar and the treasury, not to mention the irresponsibility of our fiscal and monetary policy. You lower rates, and at some point, the rest of the world just says, enough of this already. We're not going to buy their treasuries any longer. Look, you can still use dollars, but a bigger deal to the West would be not reinvesting proceeds into the U.S. Treasury market. That's deal than, I think, lack of dollar settlement, which it still represents north of 50, almost 60% of all settlements are done in dollars, if not more. The point of it is that you are killing the demand for treasuries.
Yeah.
And that's why you're seeing rates go higher, even when they're trying to talk about lowering rates and quietly coming in and doing QE. But to your point, yes, that would be the playbook. If all hell breaks loose, they're going to have to lower rates. But that just accelerates, not only it re-accelerates the engine of inflation, which really never went away, just being masked.
Yeah.
But it also, I think, accelerates the demise ultimately of this entire system, one that's based on trust. And we've lost a good deal of our trust, not just from the standpoint of the weaponization, but also from things like our monetary policy, which I think if you're a holder of U.S. Treasuries over the last few years, you understand that. The greatest volatility in the history of the 10-year Treasury was a year or two ago. The dollar's down 10% this year. So if you have a Treasury, 10-year Treasury yielding 4%, well, so far this year, the dollar's down 10% and gold's up almost 40. What's been the better play?
Right.
I think that's why you're seeing them move away from treasuries independent of the weaponization. This is just accelerate their incentive to do it.
So here's where I want to take this conversation even deeper, because I think it really matters for anyone out there still trying to make sense of what's coming next. If you've stayed with me this long, buckle up, because we're going to pull it all together. The central banks, the loss of faith in treasuries, the stealth moves by the Fed, the outright revolt by the rest of the world, and why all of this ultimately points back to gold and silver in a way most people can't even begin to comprehend. Let's just start with the point I touched on earlier, that inflation is already way higher than what the CPI is telling you. We joke it's the CP lie from the BS, Bureau of Statistics. It's funny, but it's also deadly serious. Because that's the prism through which every pension fund, every wage negotiation, every savings plan is distorted. If your paycheck is going up 3%, but your groceries and insurance and rent are up 15 to 20%, you're going backwards, period. And you go talk to someone like John Williams over at Shadow Stats. Guy's been shadow tracking the real inflation numbers for decades, stripping away all the hedonic adjustments and substitution games. And he'll flat out tell you we're running closer to 11%. And honestly, if you live in the real world, buy food for your family, pay insurance, try to afford a home, you don't need John Williams spreadsheets. You feel it. Now, why does this matter so much? Because this quiet theft of your purchasing power is exactly how the debt gets dealt with. Not by paying it down responsibly. That ship sailed decades ago, but by inflating it away. That's why central banks, the ultimate insiders, are ditching US treasuries and snapping up gold hand over fist. They know exactly how this story ends. You want a stat that will melt your brain? Since 2000, gold has outperformed the US 10-year treasury by more than 2 to 1. Gold's up over 600%, the 10-year. Maybe 250% if you stack all the coupon payments on top. And that's before even considering inflation. And in the last 2 years alone, gold's up about 75%, while treasuries have been absolutely obliterated in market value. The 30-year treasury market posted the worst return in its 250-year history. So why on earth would China, or Saudi Arabia, or even domestic US banks keep plowing their reserves into treasuries? They're not. They're rotating. They're shortening duration, moving to gold, some even into commodities directly. Because they know this monetary experiment is in its endgame. I mean, look, even here at home, the Fed talks a good game about quantitative tightening, rolling off the balance sheet, letting bonds mature, draining liquidity. But what are they actually doing? Like I mentioned, just 2 weeks ago, they quietly came in and bought $45 or $48 billion worth of 3, 10, and 30-year treasuries. Just scooped them up off the market. Why? If demand was so robust, why did the Fed need to step in? The answer is obvious. There is no real demand at these rates given the risks, so the Fed has to backdoor monetize it. And this is on top of the Treasury itself running weekly buybacks. They're issuing new short-term debt to pay off long-term obligations. That's like you taking out payday loans to pay your mortgage. It's insane, but they have no other way to keep the system afloat. They're terrified of the long end of the yield curve exploding, because if it does, the interest on the national debt absolutely swamps the entire budget. Here's something most people don't realize. Interest on the national debt just eclipsed the US defense budget. Soon it's going to pass Medicare, then Social Security. And when that happens, when the US has to print just to pay interest, you'll have a Latin American-style debt spiral, but in the world's reserve currency. That's why the insiders are moving to gold. It's also why we're seeing countries like China push harder on internationalizing the yuan, opening vaults in Hong Kong and Saudi Arabia, rolling out yuan-settled oil contracts with gold convertibility on the back end. They're building an alternative to SWIFT, to COMEX, to the LBMA. They've learned from watching what the US did to Russia, freezing hundreds of billions in reserves overnight. They know if they ever cross Washington politically, their assets could be frozen too. So they're getting out ahead of it. And this is where the election of Trump, or frankly, whoever was going to come in and escalate tariffs and weaponize the dollar even more, accelerated everything. The day Trump imposed sweeping tariffs, China didn't just shrug. She immediately went on a whirlwind tour of ASEAN nations, basically locking up regional trade lanes. They fast-tracked yuan and gold settlement infrastructure. They opened talks with Japan and South Korea to build an Asian alternative to the dollar. They started opening foreign participation on the Shanghai Futures Exchange, not just for gold, but for base metals, oil, everything. It's no accident. They're setting up a new global trade system that doesn't rely on dollars, and at the heart of it, gold. Because gold is nobody's liability. When you settle trade in gold, you're outside the reach of US sanctions. That's why China has spent decades vacuuming up gold. They used the entire bear market from 1980 to 2000 to accumulate in the shadows via the People's Bank of China. By the time they opened the Shanghai Gold Exchange in 2002 and let private citizens own gold, the state already had more than enough to backstop the yuan if needed. You know what's wild? Since 2002, Chinese citizens have pulled over 27,000 tons of gold out of the Shanghai vaults. That's not some guess. That's official delivery data, and you never see that gold again. The Swiss refiners will tell you. They almost never get Chinese bars. Once it's inside China, it's like the Hotel California. Checks in, but it never checks out. So look at what that means strategically. You've got a country with likely over 40,000 tons of gold between private and state holdings, controlling the largest physical exchange in the world, and now building out vaults all over Asia and the Middle East to facilitate gold for yuan trade. Meanwhile, the US is running $2 trillion deficits in what is technically full employment, non-recessionary conditions. What's going to happen to the dollar when the next actual crisis hits? Because here's the punchline. The Fed will be forced to cut rates and resume QE the moment markets throw a tantrum. Everyone knows it. That's why gold is already sniffing out new highs. The only question is, what will break first? Will it be the commercial real estate market, choking on higher cap rates and hundreds of billions rolling over in 2025 to 2026? Will it be corporate debt, as overleveraged zombies try to refinance at 8% instead of 2%? Or will it be political, with civil unrest boiling over as household budgets snap under the weight of higher food, energy, and rent? And that's not hyperbole. Just look at the polling out of UVA's Center for Politics. Nearly a quarter of both Biden and Trump voters said political violence would be justified if the other side won. Almost half thought it would mean the end of democracy. You overlay that with economic pain, people losing jobs, losing homes, and you get volatility, not just in markets, but in the streets. Meanwhile, in that environment, do you really think foreign buyers will be lining up to keep rolling US debt? Of course not. That means the Fed steps in, prints to cover the gap, and the dollar gets torched. That's your final crack-up boom moment for gold and silver. And this is why I keep hammering silver. Because even after everything we've talked about, the multi-decade debt bubbles, the pivot by central banks to gold, the slow motion de-dollarization, silver is still historically cheap. You can buy 80 ounces of silver for 1 ounce of gold. During previous monetary crises, that ratio has collapsed to 15 or 20. If that happens again, you're talking 3 to 4. X leverage to the upside just on the ratio normalization. Not to mention silver's own supply crunch. Industrial demand from solar and electronics is at records. Investment demand is still asleep. That's your once-in-a-generation setup. You get to front-run the next wave. And when it happens, it'll move fast. Because silver always lags gold at first. Then when confidence finally breaks in fiat, silver goes vertical. It's what happened in 1979 to 80. It's what happened in 2010 to 2011. And it's what's brewing right now. And look, I get people saying, but Andy, what if I'm wrong? What if the Fed miraculously threads the needle and we get a soft landing? To which I say, great. You still own gold and silver. They're insurance. They're not going bankrupt. They're not defaulting on their promises. And if inflation stays sticky at 4 to 5% while your cash yields 0% after taxes, guess what? You're still better off with metals. And if I'm right, and we're headed toward a massive reset, whether that's through currency devaluation, debt restructuring, or outright political revolution, your metals portfolio could end up being the single best financial decision you ever made. So, this is your wake-up call. This is where you want to be paying attention. Don't wait until gold's at $5,000 and silver's blasting through $75 to call your broker. Do what the insiders are doing. Do what the smart money is doing. Front run the shift. Don't chase it. And hey, if you want a bit of humor to end on, I saw a tweet the other day. Gold is for doomsday preppers. Silver is for moon landing believers. Bitcoin is for gamblers. Treasuries are for suckers. And dollars are for suckers who can't do math. And I thought, well, that's not entirely wrong. Except it leaves out the punchline. When the dust settles, only one of those will still be recognized globally as money. It sure as hell won't be Bitcoin or your local currency with 14 zeros stamped on it. So stack smart. Be early. And remember, monetary resets are rare, but they're also inevitable. You don't want to be on the wrong side of it when it finally hits.